In the weeks before the 1930 collapse became undeniable, history was not loud. History was silent. It didn't feel like catastrophe. It felt normal. Newspapers were calm, markets still functioned, investors still believed the United States was entering a permanently prosperous era. The fear that people associate with the Great Depression today did not exist then. The world did not feel like it was approaching disaster. It felt like it was stabilizing. That is the part most people never understand. Collapse does not begin in chaos. Collapse begins in confidence. In the summer of 1929, the average American investor believed the future was bright. Economic growth had been strong throughout the 1920s. Industrial production was impressive. Corporate profits were rising. Automobile adoption was climbing. Radio, consumer goods, household appliances, entertainment, aviation, communications. The decade was defined by belief in endless progress. Economists, politicians, bankers, brokers, nearly everyone believed the business cycle had been conquered. They believed downturns were a thing of the past. When historians study the Great Depression today, they often search for the obvious trigger. But the true cause was not a single event. The true cause was the same universal mechanism that ends all economic cycles: excessive optimism priced as permanent reality. In the final weeks before the collapse became visible, there were early signals, but they were interpreted incorrectly. Credit was tightening quietly beneath the surface. Money velocity was slowing. Corporate earnings were beginning to flatten. But instead of seeing these as warnings, investors saw them as temporary distortions. People believed the economy was simply cooling in preparation for a stronger next phase. Nobody believed the party was ending. Everyone believed the party was evolving. When the stock market began slipping in late October 1929, the initial reaction was not panic. The initial reaction was confidence. Analysts called it a healthy correction. Editorials argued the decline was a brief pause. Most people assumed the dip was a buying opportunity. They believed the economy was fundamentally strong and the market was merely adjusting. The public reaction tells you everything you need to know about the psychology of collapse. Collapse is not fear-driven in the beginning. Collapse begins with belief. The reality is that by November 1929, the structural collapse had already begun. But people misinterpreted the early signals because the narrative of endless prosperity was stronger than the data showing deterioration. This is why studying the final weeks before the 1930 collapse is so important today. The pattern is not about charts. The pattern is about perception. Collapse is invisible when people believe stability is normal. Collapse is invisible when optimism is more powerful than math. Collapse is invisible when the majority believes history is not relevant anymore. In December 1929, banks began feeling stress. Not publicly, internally. Loan books were tightening, lending standards were shifting. But the public narrative stayed optimistic. People believed banks were safe because banks had always been safe. The Federal Reserve still looked confident. The government still appeared calm. Politicians made speeches that prosperity was America's destiny. Economists wrote papers declaring that the worst was already behind them. These are the words that always appear in pre-collapse environments. The system was weakening, but narrative was still strong. By early 1930, industrial production was slowing, exports were softening, inventories were rising. But because the decade before had been a decade of explosive expansion, nobody believed slowdown meant reversal. They believed growth was simply taking a breath. They believed the curve would resume upward. The American psyche had internalized a dangerous assumption. The economy only moved in one direction. History punishes assumptions. The system cracks long before the public notices. By February 1930, unemployment began to move. Not dramatically, just slightly. But this was the second true signal. Employment softening always arrives before collapse, not after. Yet the public interpreted this as a short-lived adjustment. The business community believed the slowdown would self-correct. The Federal Reserve did not send warnings. There was no national alarm. There was no psychological permission for fear. The public still believed the downturn was temporary. People anchored their perception on the previous decade, not the current reality. This anchoring bias is one of the most consistent precursors to collapse in every era. By March 1930, corporate leaders were giving optimistic speeches. Quarterly reports contained cautious language but not panic. Companies believed demand would rebound. Consumer culture in the 1920s was conditioned to interpret uncertainty as opportunity. Americans believed they were living inside a permanently rising world. Even as underlying industrial activity deteriorated, sentiment remained aggressively confident. This is how history always builds the final setup. The people inside the system cannot emotionally detach from the belief that the system will correct itself. By April 1930, bank credit continued to tighten. Banks did not trust borrowers the same way they had trusted them 2 years earlier. In every credit cycle breakdown, banks become cautious before the public becomes fearful. Bankers don't need headlines to see danger. Bankers have loan books. Loan books speak earlier than news. And in early 1930, the loan books were already whispering that the expansion was over. But the public did not hear those whispers. They were listening to optimism instead. They were listening to the memory of the Roaring Twenties. They were listening to a decade of propaganda that taught them markets only go up. Confidence remained intact, even while structure had already broken. This is the pattern that has repeated across empires and centuries. The data collapses before the belief collapses. Collapse is not when truth breaks. Collapse is when illusion breaks. In mid-1930, illusions were still unbroken. The public still believed America was invincible. They believed downturns were temporary dips, not signals of structural reversal. They believed prosperity was permanent. The most revealing fact about the pre-1930 phase is not that people were wrong. The most revealing fact is that they were devoted to optimism. Once a society becomes addicted to optimism, the disease is terminal. Optimism blinds the population to hard signals. Optimism defensively rejects negative interpretation. Optimism becomes a drug that buys time and accelerates destruction. A society high on optimism is incapable of recognizing decline. That is the condition America lived in during the weeks before the collapse became undeniable. History is not asking us to be cynical. History is asking us to be real. The end of a cycle is almost never recognized while it is happening. The people inside the collapse zone are always the last to understand they are in it. They only realize it after the collapse has already arrived. In 1930, Americans were not living in crisis. They were living in denial. They were living in disbelief that their model was vulnerable. They were living in the belief that prosperity had become permanent. And while they believed, the correction matured. This is what the days before collapse feel like. Not fear, comfort, not panic, numbness, not shock, blindness. Collapse does not begin when people are terrified. Collapse begins when people are certain they are safe. In May 1930, the U.S. economy was still functioning. Production was slowing, but it had not fallen off a cliff. Banks were cautious, but not failing. People did not feel collapse. The atmosphere was more like mild unease than panic. Most citizens still believed the downturn was temporary. American psychology was still anchored to the Roaring Twenties, still convinced that prosperity was the default, and any decline was just a passing phase. But under the surface, credit was fragmenting. Banks began refusing marginal borrowers quietly. Corporations started scaling back expansion plans. Inventories began to sit longer. These signals were only visible to insiders, finance executives, large industrial managers, economists with access to raw production data. The ordinary public had no exposure to these internal signals. They only saw the surface: shops open, factories operating, trains running, newspapers printing optimistic editorials. To the average citizen, nothing looked like collapse. This is the critical detail that repeats in every major historical collapse. Collapse is psychological lag. The data collapses before the belief collapses. The structure collapses long before the narrative collapses. The U.S. in 1930 was not experiencing despair. It was experiencing delay. And while the public delayed emotionally, the world was shifting geopolitically. The global post-World War I debt system was already unstable. Europe owed massive war debts to the United States. Germany was under the pressure of reparations. Britain was struggling to maintain the gold standard. The world economy after the war was not balanced. It was fragile. It was like a massive financial architecture held together by confidence and hope instead of structural strength. When the U.S. began tightening credit quietly, the world felt it instantly. The United States was the creditor to the world in the 1920s. Once America started hesitating to lend, the entire international financial system began to slow. When America's credit cycle turned, global trade slowed. When global trade slowed, commodity prices fell. When commodity prices fell, exporting nations destabilized. Collapse in the modern world is not domestic. Collapse is global chain reaction. The world economy in 1930 was wired through American finance. Every small pressure point in the U.S. transmitted outward. At the same time, the U.S. government made an extraordinary mistake, a historically catastrophic miscalculation. In June 1930, the Smoot-Hawley Tariff Act was passed. The idea behind it was protectionism: protect domestic industry by taxing foreign imports heavily. Politicians believed this would help the economy. Instead, it strangled international trade. Countries retaliated with their own tariffs. Within months, global trade started freezing. This is the moment history always repeats in empires, when fear triggers protectionism. The U.S. did not collapse because other nations attacked it. The U.S. collapsed because it cut itself off from the world's economic bloodstream. Collapse is not always an invader at the door. Collapse can be self-isolation. Collapse can be self-inflicted damage. By late 1930, America was still not panicking. The stock market had fallen, yes, but many analysts still believed recovery was coming. People believed that once uncertainty cleared, business would rebound. They did not understand that structural damage had already happened. Credit had broken, trade had broken, trust had broken. Collapse is not announced, collapse is discovered. Banks began to fail in rural districts first. Small agricultural banks started closing. Depositors in small towns started losing savings. At first, people thought these were isolated incidents. The national papers framed them as regional anomalies. But each small failure was not a local error. It was a node in a collapsing network. By autumn 1930, the failure pattern expanded. Failures spread from rural banks to urban banks. Businesses began to postpone hiring. Factories that had been expanding in the 1920s now reduced shifts. Unemployment began accelerating, not gradually, but exponentially. This is the signature of systemic collapse. Things deteriorate slowly, then all at once. Collapse is not a straight line down. Collapse is a long horizontal line followed by a vertical drop. And while this was happening, the world outside the United States was reacting. Europe saw America's lending retreat, and panic spread through banking systems that were already fragile. Countries that relied heavily on U.S. capital now faced capital starvation. Global credit conditions tightened. Nations scrambled to stabilize currency values. Some abandoned gold. Others defended gold at the cost of their own domestic economy. The British pound wobbled. The German banking system strained. Commodity exporters collapsed under falling prices. The world economy was not just slowing, it was convulsing. This is what historians misunderstand when they summarize the Great Depression as a market crash. A market crash is a symptom. The true mechanism was the collapse of global credit, amplified by protectionism, transmitted through fragile international debt structures. The collapse of 1930 was not a single event. It was a global synchronizing failure. The tragedy is that the public in 1930 still did not understand what was happening. Even as banks failed, they believed recovery was coming. Even as global trade froze, they believed it would thaw. Even as credit contracted, they believed the downturn was temporary. This is the core lesson. The public always interprets systemic collapse as temporary, until the moment it is not. By the end of 1930, the U.S. was entering the worst depression in modern history, but most Americans did not know it. They believed 1931 would be a recovery year. The newspaper said so, the banker said so, the politician said so, the experts said so. The same words are spoken in every empire before collapse. This is temporary. Collapse is not chaos first, collapse is denial first. The days before the 1930 depression did not feel like collapse. They felt like waiting. They felt like a tense pause. They felt like the world was holding its breath. The mind of the citizen cannot comprehend massive change while standing inside the comfort zone of normal life. Collapse only becomes visible after comfort has vanished. The years after 1930 revealed something devastating about collapse. It accelerates after the illusion breaks. The world did not wake up one morning to headlines saying, "The Great Depression has begun." Instead, it was a sequence of cascading events, each one making the next inevitable. By 1931, bank failures were weekly. By 1932, they were routine. By 1933, they were catastrophic. People did not panic first. They panicked after the system stopped functioning. Factories closed because demand collapsed. Demand collapsed because money supply collapsed. Money supply collapsed because credit collapsed. And credit collapsed because trust collapsed. Confidence is not a mood. Confidence is the oxygen of a financial system. Once confidence evaporates, math becomes destiny. Bank runs were the physical expression of psychological collapse. People lined up not because banks were weak, but because people no longer believed banks could survive. In a fractional reserve system, belief is more important than reserves. If depositors believe the bank is safe, it is safe. If depositors believe the bank is unsafe, it becomes unsafe. In 1930, collapse was mathematical. In 1931, collapse became emotional. That emotional shift is the transition line in every major systemic breakdown. The early signals in 1930 were ignored. The mid-signals in 1931 were resisted. But the late signals in 1932 could no longer be denied. Unemployment exploded. Breadlines formed. Families lost savings. Businesses died without credit. Nations defaulted. International systems fractured. The global slogan of the early 1930s could have been summarized in 3 words. Too late now. This is the cruel timing of collapse. Once the public finally perceives the danger, the room to escape has already disappeared. The exit door exists only during denial, not during panic. By the time panic arrives, the room is already burning and the exit is already gone. This is why studying the days before collapse is so important. The days before collapse are the only days where collapse can be prevented. Now look at today. The world in the 21st century is living inside a similar psychological phase as the world lived in early 1930. People see economic deterioration, but they interpret it as temporary. Politicians talk about challenges, but they frame challenges as cycles. Economists see debt rising faster than GDP, but they describe the imbalance as manageable. Technology and entertainment mask the fragility. The public feels discomfort, but that discomfort has not yet become fear. The global system is brittle, but the narrative is still optimistic. This was exactly the psychological condition in 1930. People thought the 1920s prosperity momentum would return. Today, people think the pre-2020 prosperity momentum will return. In 1930, the world believed the downturn was a short correction. Today, the world believes the same thing. In 1930, governments responded with policies that accelerated collapse, like tariffs and protectionism. Today, nations are once again shifting toward protectionism and economic nationalism. Trade is fragmenting, supply chains are regionalizing, currency blocks are forming, global coordination is weakening. History is repeating not in aesthetics, but in structure. In 1930, collapse became unstoppable, not because conditions were bad, but because the world reacted emotionally in the wrong direction. When fear finally replaced confidence, the instinct was to protect, to isolate, to prioritize self-interest. Cooperation died, and fragmentation accelerated the crash. Look around today. Countries are deglobalizing, currencies are polarizing, trade alliances are shifting, debt is expanding faster than production. These are not random coincidences. These are the exact same macro signals that existed in 1930, but now multiplied, amplified, and transmitted through a system that moves capital at digital speed. The single most important lesson of 1930 is not economic, it's psychological. The public does not feel collapse until collapse is already irreversible. The same denial that existed then exists now. In 1930, people believed their era was different. Today, people believe technology makes their era immune. In 1930, the public believed they were too modern to collapse. Today, the public believes they are too advanced to collapse. This is not intelligence. This is bias. This is the ego of a civilization that cannot imagine itself fragile. The 1930 collapse teaches us one more brutal truth. Collapse does not need enemies. Collapse does not need war. Collapse does not need violence. Collapse only needs the system to become mispriced against reality. When belief becomes more powerful than mathematics eventually destroys belief. And this is where the mirror closes. The days before the Great Depression did not feel like crisis. They felt like mild discomfort. The pain came after belief finally shattered. The warning signs were visible, but the population dismissed them because they wanted to believe in the story of endless prosperity. People choose comfort over truth until comfort is no longer possible. And that is the most dangerous moment for any society, the moment it replaces vigilance with assumption. The next collapse, if it comes, will not look like the movies. It will look like 1930 looked from the inside. Normal at first, calm, not alarming, not dramatic, just slightly more difficult each month until suddenly it is too late. The lesson of 1930 is not about the crash. The lesson is about the denial before the crash. History is not warning us about chaos. History is warning us about complacency.